FutureDDS family. Today we have a very special interview for y'all. When deciding on what dental school to attend, there are a lot of factors to think about. And one of those main factors is money. No, maybe an extra 50K or 75K won't make a big difference. But what about in 20 years when that debt has compounded due to interest? It's something to think about. And today we have a very special guest who's going to teach us about how the dental school loans that we take on today are going to affect us tomorrow. I would like to welcome Rowan who works with an investment banking firm and has experience consulting dentists and dental specialists. He has a lot of sage advice to give us on dental student debt. And as an added plus, he has provided an interactive Excel sheet that you can download in the bio of this video, and so that we can follow along while he teaches. Rowan, thank you and welcome.
Sure, thank you, Nick. So like Nick said, I'm Rowan. So currently I work for kind of a small private investment firm in San Francisco, but previously to that, in college, I was pre-dental. So I took the DAT, I took all the science classes, I volunteered at a clinic, I was a dental assistant, and so I kind of went through this pre-dental track. I applied to dental school, interviewed, got in, and then sort of had to make a decision on whether or not I wanted to actually go. So I was a business major also, and I had done an internship with this small investment firm and was sort of deciding between the two. And at the end of the day, for me, it kind of came down to one, I was a little nervous about the debt. And then the bigger piece of it was actually I couldn't see myself doing sort of chairside, patient care for 30 to 40 years. And that's something I realized by dental assisting. And so, I sort of realized that, and I sort of said no to the dental schools. And now I work in San Francisco for this firm. But sort of during college and before starting work, I helped run a dental group, kind of a multi-location dental group down in San Diego. And I still help with the group out in Oakland. And so I have experience kind of on the operations side of running a dental practice. But today, kind of what we're talking about specifically is, how that loan you take when you start school, or how the cost of attendance when you're making a decision for which school to go to can really impact your future ability to sort of, get out of debt, save for retirement, sort of do the things you want in your life, because it's a big sacrifice you're making up front. And I think I just personally feel that the schools don't do a good enough job of telling students what the debt is actually going to look like. I don't think we do it well at the pre-dental level in terms of college. I don't think we do it well at the dental school level. And even post-dental school, there's a lot of dentists who have no idea how to manage their debt or even what it means. And I'm not here to save everyone's life, but I have that kind of financial modeling background, and I have the ability to build this, spreadsheet, which is not that complicated, but I learned how to do this stuff in school. And so I feel like if I can, pass on some of that knowledge, it could be potentially helpful. And I've given this talk at the pre-dental level a lot, in kind of at the Berkeley Pre-Dental Society, at the Berkeley Free Clinic where I used to volunteer. And so I've given it to that audience, and I've also given it to actual dentists, right, who are out of school and who have the loan already and have the debt, and are sort of asking, like, how do I get out of this, right? And these are dentists that I worked with down in San Diego, and they're pediatric and orthodontists, and they went to school, they went to residency, they have all this debt, and they're like, how do I pay this off? And just kind of on a casual basis, I sort of showed them this spreadsheet on, like, okay, well, what kind of payment do you need to make every year, every month to get you out in 5 years, 10 years, right? Whatever your goal is. Because I think the numbers aren't it's not as simple as people think, but it's also not as complex as people think. And so just visualizing it, putting it into numbers, having something that you can take ownership of, I think is important for pre-dentals and dental students. So looking forward to helping out, and feel free to always, reach out for me if you need guidance. But okay, so I'm going to share my screen on the spreadsheet I built. And I built this back in 2019, and actually and I'm not looking away from you guys. I'm looking at my monitor, but the reason I built this spreadsheet is that my girlfriend Marina is a dental student, so she's at UCSF. She's a second year now, but I built this when she was starting her first year, because their loans were dispersing, and I was like, you need to see what this means, like what that loan you're taking every quarter or every semester actually turns into, or what that means kind of for your future. So I built this because I was curious too, right? Because I was like, maybe I'm the crazy one. Maybe the debt is not, I thought it was bad, but maybe it's fine, right? Because everyone graduating seems fine. So I built this, to sort of show her. But so I think the easiest way is for me to just run through this kind of line by line on how it works so that you can play with it and enter your own numbers as you're going through it. And then maybe at the end, I'll leave 10, 15 minutes and Nick can ask some questions and we can go back and forth.
Yeah, that's perfect.
I put my contact info up here, so feel free to email or text is fine too. And I'm happy to like call or set up time on Zoom to walk through on a one-by-one basis. But the way this works is in this first gray box, and I think I'm zoomed in enough so you can see it, you basically put in your cost of attendance, right? And so what I would do for this is whatever school you're looking at, so in this case, I was looking at UCSF, I just basically went to their website and went to cost of attendance for dental school, and you basically just sort of, whatever your school is going to look different, but add up all the costs of attendance. So that's the tuition, that's the lab fees, that's the living expense, right? And so for UCSF, it comes out to about 80 to 90 grand a year, depending on how you live or how cheaply you live. And so, for conservative numbers here, and we can model UCSF today, I can just say, let's just leave it at 400, right? Because I said that's probably the high end of what you'd have to take. Most people probably closer to, 300-ish. But let's do 400 just for giggles. The next thing is, like, let's say you're going to have someone help you, right? So maybe your parents are going to help pay for it, or grandparents, you have some money saved up, right? So whatever that is that's going to reduce your loan amount, meaning you're not going to have to take as big of a loan, put that in here. So, right, let's say someone gives you a gift of 10,000, so you're not going to have to take, as big of a loan. So then this spits out your loan amount. And then this next table basically just divides that over the 4 years. So the way the school loans work in dental school is UCSF is on the quarter system. Some schools are semester, but at the beginning of every semester or quarter, your loan will disperse, right? Like a piece of loan or a loan will be dispersed to you that helps you cover the costs for that quarter. And so, this is just split so that it's even. It may not always be even. Some quarters might be more expensive or whatnot, but for our sakes, I just made it all even. So like in quarter one, you're going to get a loan of $32,000, right? That you can use to pay your rent, to pay your tuition. And it usually disperses like a week or so before tuition is due. So anyways, and those dates I built into this blue table here. And again, I did this back in 2019 for kind of UCSF's first year. Anyways, you can mess with it and put your own kind of data in. This little checkbox is just to make sure that this all adds up to the 390. So that's just, if it's red, then, and you've messed with these numbers, then sort of make it so that it turns green. So interest rates. So interest, for those who don't know how kind of loans work. So when a bank gives you a loan, they have to make some money on it, right? And the money they make is interest, because if they don't charge interest, then they basically make nothing and you just pay back the full amount. So with interest, you pay back the loan, plus you pay back the interest. And so I just updated these numbers, actually. I looked this morning. So there's on kind of the student aid government website for graduate or professional borrowers, the first tranche of loans you take is at 4.3%. And so basically in dental school or for professional school loans, they give you these unsubsidized loans at 4.3% interest. And that's up to your first 250 grand in debt. This 250 might have changed. It might be a little lower now, but basically for the first 250 grand you take, right, for our purposes, the interest rate on your loan is going to be 4.3%. And then any amount you take over 250 grand, the interest rate is going to be 5.3, okay? Dental school loans accrue interest daily. So not many loans accrue interest daily. Most of them are kind of monthly or yearly, but professional school loans accrue daily. And so this number is sort of every single day, whatever your loan balance is, multiply it by that, and that's the interest that you're accruing, every day while you're in school and after. So that's, I'm getting into the nitty gritty, but I want you guys to understand what these are so that you can play with them. You don't really need to edit this table, but just so you understand. So the caveat with the dental school loan, it's not a caveat, but it's important to know, is that the interest starts accruing while you're in school. So as soon as you take that loan, and this is different from undergrad loans, because undergrad loans start accruing when you graduate. Professional school loans start accruing when you start school. So if you check your loan balance every day, it'll be going up every single day while you're in school. despite the fact that you have no way to pay it back, right, while you're in school. So, but anyway, that's important to know, because it's not just happening when you graduate. So, so what can you do about that? Well, you can't change the way the loan terms are, but one thing you can do is you can really try to limit the amount of loan you take every quarter, right? So what you should do is you should only take a loan for what you need to get through that quarter with a little bit of cushion, because the next quarter you're going to get another disbursement, right? But what you don't want to do is you don't want to front load a big loan at the beginning of the year, because then that whole loan starts accumulating interest, right, as you go. So you want to just take what you need every quarter. And, if it stretches you a little bit, then it stretches you, and then you get kind of to the next quarter. So I would recommend to just take kind of right at what you need and give yourself a, maybe a 10% cushion over that for any kind of, unexpected expenses. But it does accumulate as soon as the loan hits your bank account, it starts accumulating. So take it little by little as much as you can. So this highlighted number is the kicker, right? So what did you take? You took a $390,000 loan. And by the time you graduate, you've done nothing but be a student. You've accumulated 35 grand in interest, right? Just from being in school. And so I think, I don't know if everyone knows that. I'm assuming they do, because they see their monthly statements, but that's important, right? So that comes out to 8% of your overall, of the starting loan, or of the overall loan is now interest, right?
Mm-hmm.
Which is a big deal. And so that's why I really encourage you to just take as little as you can per quarter. And really sort of try to stretch it. But so anyway, so you've gone to UCSF, you have this great degree, you've taken this loan out, you've accumulated a little bit of interest, but you're like, whatever, because you have your dental license. Now the question is, like, are you going to specialize, right?
Mm-hmm.
So the kicker with specializing is, if you specialize, then you get to defer your loan payments, right? So they're not going to make you pay back your loan while you're in residency, but like in dental school, your loans still accumulate interest. And so specializing is, I recommend it because I think it kind of dramatically increases your income, but you have to remember that your loan balance is actually going up while you're in residency, okay? So this table is, a bunch of numbers, but the easiest way to do it is to play with this drop-down menu right here. So pick a residency, what you're going to do, right? So let's say you do no residency, you're going to be a general dentist. Remember, you started with $390,000 in debt, and you accumulated 34 grand. And this pie chart basically spits out your total loan, and then, what you start with and what piece of it is interest, right? So let's change that. So let's say you do a two-year pediatric residency. So now, interest takes up a bigger chunk of the loan, and you can see for a 2-year residency, your total amount is now 460 grand, and 71 of that, or 15% of that is from interest, right? And as you can see, if you do a full-on 6-year OMFS MD residency, and this doesn't even include the debt that you may have to take on to pay for the MD, like for the medical school, you're graduating with 550, and 30% of that loan is just interest, right, that you owe. And so it's just important to know that. I will say, I do not discourage anyone from going to school because of the debt, but I encourage that you know what you're getting into, right? Mm-hmm. So I think these numbers are high, like too high. I think it's overpriced, but we obviously can't control that. And so, it's happening all across education. It's not just dental school. And so you can't control what the number is going to be, but you can control how you plan for it, and you can control what school you go to, right? And the school you go to dramatically changes the cost of attendance. You can go to UOP, you can go to ASDO and pay, whatever, what's the other one? USC, NYU, pay 600 grand to go to dental school. Mm-hmm. And, I'll put in 600 grand. Let's say you go to NYU, right? Or Columbia. I forgot there's one, let's say you get no parental help, right? $600,000 loan. You go do OMFS, you have a almost $1 million loan, right? And so the point of all of this is, be scared. The number is big, but it's payable. It's just, you just have to do a little bit of planning, and you just have to know. I just encourage you to know what the amount is, right? Don't go into it blind and just say, like, it's all going to work out. Like, every dentist I know is so happy and, has a nice car and a nice house and everything's fine. Like, those dentists went to school in a really different time than you did, right? So when you go in to shadow a dentist who's in their 50s and they're telling you how great dentistry is and how happy they are and how successful they've been, you have to remember that their cost of education was not $400,000, right? It was dramatically less. And so what I would encourage is go talk to someone who just graduated, right? Who's just started working in private practice or wherever, who just started working, who's maybe a couple years out. Go shadow them, right? And go ask them how they feel about the debt and how they feel about, whatever. I think you'll hear a different story. People still might love their job, but there's this impending debt on you, right? And so the point of all this is be a little scared, because the number, it's hard to not be scared when you see the number. Know that you can pay it off if you plan properly, and just be smart about it and be educated, and don't be blind to the debt, right? Don't just think it's all going to work out. You have to kind of plan around it. And so the purpose of this first page is basically just to show you, like, well, what's the debt even going to be, right? Like, how much are you even going to owe? So that's this page. Nick, any questions on that I should clarify before jumping into payback?
Yeah, so let's say your residency does require you to pay a certain amount, like for oral surgery, you have to pay for the med school.
Yeah.
How would you be able to factor that in on this sheet, or is that possible?
Yeah, so I haven't built it out to factor in kind of increased debt. I'll show you on the next page. We can sort of kind of hard code it in, but in terms of residencies that charge, so just to dig into that for a sec. So for OMFS, you likely have to pay for them. If you do a 6-year program, you get MD, and you'll likely have to pay for the MD in the sense of you have to pay for the school that it takes to get the MD. Other residencies that charge are basically all the non-hospital based residencies. So anything done in a dental school is likely going to charge you tuition. Certain states in the South are pretty good about giving you a big stipend to cover that. But generally speaking, if you go to a dental school for residency, you're going to get charged. If you go to a hospital for residency, so like if you do pediatric dentistry, if you do a hospital-based residency, they actually pay you to do a residency. But if you do a pediatric residency in a dental school, then you have to pay tuition. So, 50-50, right? You might have to pay, you might not. Endo, you're probably gonna have to pay. Ortho, you're probably gonna have to pay. It's usually a smaller amount, maybe 30, 40,000 a year, which the fact that we're calling that small is just tells you the scale of the dental school costs.
Yeah.
But it's yeah, we can play it. And I think the next iteration of this sheet, of this worksheet, will be for me to build in not only a residency debt, but also to build in, like, what if you buy a house when you graduate, right? What if you buy a car or a dental practice? How does that debt play into your overall thing? But for now, I kind of want to focus on, because I think this is targeted to pre-dentals, and so I really want to focus on the debt that you get from going to dental school, right? From even doing that first step. But yeah, good. I think it's good that I can kind of spice it up for other stuff. But so this is assuming you go to residency that's where you essentially net zero. So you don't have any income and you don't have any expenses. So maybe it's one of those that you have to pay, but you get a stipend. So it's pretty much zeros out.
Gotcha. Okay.
Yeah.
Well, yeah, I think we're good on this page. You explained it all in good detail. So.
Okay. Cool. Yeah, and some of this stuff I haven't done a lot of edits recently. So I just changed the interest rates this morning because I noticed that they were a little high. But anyway, so feel free to update it if you find stuff that needs to be changed, or even formulas that could be simpler or that are maybe even broken. Feel free to update it. Okay, let's go into repayment. So you've graduated, maybe you've done a residency, maybe not. You have this license, you have this fancy job. So now you're trying to do all these things in your life that all of your engineering friends have been doing since they graduated college, which is, they graduated college, they went to work, they were getting paid, they went on vacation, they were, buying a house, buying a car, having kids, and you've been essentially slaving away in school for whatever, 6 years, 4 years, 10 years. But you're out, you have your degree. So how do you pay it back? And so first thing on this blue table, so basically for this page, the blue table is what you mess with, and this graph is what it spits out. So this is your remaining loan balance over time. So first thing you do is plug in the year that you're going to graduate school or residency. So I'm going to say, for these purposes, you went to UCSF and you became a general dentist, right? So you started in we modeled it to start in 2019, whatever. So you graduate in 2024, okay? You did no residency, so select the residency that you did. So you did no residency. So this is that loan amount, and this is just pulling directly from this page, no residency, total amount due. So that's the starting loan balance. So you can see in 2024 or 2025, you start with 400,000, right? So you have this loan balance. Now you need to put in your income. So what's your income going to make? So I'm going to tell you for San Francisco, you're a general dentist in San Francisco. On the low end, you'll make 400 to 450 a day. And then on the high end, you'll make 600 to 650 a day. So let's estimate you're making $500 a day. And let's say you're working full time, right? So $500 a day, 5 days a week, 50 weeks a year, okay? You're making $125,000 a year. You had your loan, $400,000 from UCSF. I'm going to say your income grows at 2%. Inflation is around 2%. So let's just say your income is just tied to inflation, that your boss just gives you a 2% raise every year, okay? And majority of dental students now go work in group practices. And so 10 years ago, this would have been like, what do you pay yourself in terms of you starting your practice and whatnot? But nowadays, the majority of dental graduates, especially general dentists, go work for somebody else. I'm assuming that you're just, you're an employee here of a dental practice. So you're making 125 grand. So we'll skip this yellow. I'll come back to it because it's honestly the most important thing out of this whole spreadsheet. Federal and state income taxes, let's say, I don't know why this got really low for some reason. I'm going to say that's 27%. Let's say you're in California. I actually don't know what the bracket is for 125,000, but let's just say it's around, you're paying like, what are you paying? 34% in taxes, okay? Right. This green just is building this, this graph. So if you want to dig into it, but it's not super critical. Sorry, there's a dump truck outside. I don't know if you can hear it, but anyways, so you fill it out. City income tax, really not many cities that do that, but I'm sure San Francisco will at some point. But anyways, now the kicker is how much you're going to pay back, right? So this is modeled percent of income you put towards your loans, and this is pre-tax. So it's not pre-tax. You don't get a deduction for this. Some loans, and you may hear this, is that, you can deduct the interest from your taxes. So if your income is $100,000 and you have $10,000 in interest expense on a loan, your taxable income becomes $90,000 because you can deduct the $10,000 from it, and then you only pay taxes on the $90,000. That applies for professional school loans, but there's an income limit. So I think it's if you make above $160,000, you cannot deduct your income interest. You cannot deduct interest from your income. I don't know the exact number, and it changes, with every tax code. But I'm going to assume for the most part that you're making above that, and you can't deduct the interest, right? And so I say pre-tax here, not in the sense that it's a deduction. I'm just saying I'm calculating it based on you're like, I make 100 grand. And I want to pay 30% a year towards my loan. So I'm going to pay 30 grand a year just to keep it kind of conceptual. So 30% a year means you're going to pay 30% times 125 grand a year towards your loans. Okay.
Right.
So, I noticed this is 2025, and that's because that's when you start paying your loan back. So that's why it's less than the 420. But So Nick had asked me the question of like, what's a good percent? And I think what's a good percent to pay back? Well, I would argue as high as you possibly can. This, for a number of reasons, exponentially increases or decreases your repayment time. And the reason is because of interest. So that loan that you graduate with, this 420 grand, you are accumulating interest on that loan, even as you're paying it back, right? The remaining loan balance is accruing interest. And so the faster you can pay it back, the less total interest you'll pay back on the loan. So the faster you pay it back, the less total interest you'll pay on the loan. And so making a bigger payment this year decreases the interest that accrued this year, and your loan amount is going to be smaller next year because of your payment, and also because the interest, there's not as much to accrue on for the interest. So there's math behind it. Don't worry about the math. Simple way to think of it is the faster you pay it back, the smaller your actual total loan that you'll ever have paid is decreased. I like 30%. It's very hard for a general dentist to pay back a $400,000 loan, $420,000 loan, making $125,000 a year. But you can see with 30% it becomes possible, right? And so for me, I like 30% because this is, you graduate in 2024. This is 12, 13 years post-grad that you've paid your loan off. And for me, I would target a 10 to 15-year payoff of your loan. I think one thing you won't feel in school, but I think you'll feel after, is that this student loan will hinder other abilities in your life, right? So I think it'll hinder you're like, you want to buy a house, but you're like, I have all the student debt. Like, can I really buy a house, right? You're like, I want to buy a car, I want to buy a practice, whatever. And having the student debt hanging over your head is, I think, really stressful. And, I'm not a bank. I don't like make any money off of this or like doing any of this. So, like, it's really, I'm just trying to educate you guys on, how this stuff works. And if it was me, I would try to pay it off as soon as possible, right? And if that means living like a student for 4 or 5 more years, right? Living in the same apartment that I lived in during school, and just every paycheck, just, 50% of it just to the loan, right? Just pay it off as fast as possible. That's how I would handle it, because I would have trouble sleeping knowing that this thing is just like hanging over me, and accruing interest. So let me, let's simulate a residency, right? So let's say you do a 3-year, it's kind of in the middle, 3-year residency. So the way I get these incomes, the San Francisco one I just know because of the group I work with. But the ADA, the American Dental Association, did a survey, and I linked it here, and they put it into kind of spreadsheet format. But the high levels are here, right? So the average net income is 190 grand, and the specialist average net income was 330. So for our purposes, we'll use 330. But if you want, there's a great spreadsheet that you can download right here, and it's from 2018, so it's a little old, but it goes by specialty. It tells you like profit margins for the different practices, marketing. It's pretty neat. I would recommend digging into that. But it gives you a sense kind of for the incomes, for the average incomes, because if you're in California, it's a little skewed. If you're in the South, it's a little skewed. So it gives you a good sense of average income. But let's say we're modeling kind of the average specialist, 330 grand. Okay.
Mm-hmm.
You did a 3-year residency, right?
Yeah.
You graduated with 480 grand. This is assuming you didn't get any more loans you didn't get any more loans in residency, but whatever. Look, if you pay 30%, this sucker's paid off in 4 or 5 years, right? And so what this should tell you is this should encourage you, right? This should tell you that the loan is big, but you're working towards a higher income, and so it is very, very feasible to pay it back. But what you should not do is graduate, you make 300 grand, buy a house, buy a car, and then you can only afford to pay back, let's say 10% a year, right? And now look, now you're on a 20-year, now you graduate, right? Let's say you did a residency, so you graduate in 2027, right? So 2044 is when you pay it back, right? And so, make this 20%, right? Double it, but it cuts your loan by 10 years, even though you just doubled the amount you're going to put in. And so that's my point, right? And that's why this box is yellow, is because the loan amount doesn't matter. Okay, other things matter, but not as much, right? Forget the loan amount, forget the income, forget the taxes. This number is single-handedly the most important thing you can do. Now, you can help it by living in a low-tax state, somewhere with no state income tax, Texas, Nevada, Washington, there's whatever. There's a list, right, of states with no state income tax. Right. You can help yourself by going to a state school, that's public and affordable, or in a city that's affordable, so your living expenses are really low. You can help yourself by joining a practice that's sort of growing and profitable, that you can take a bigger income from. All of these things help you, but this is the one thing that is fully in your control and can really make an impact, right? It's the only thing in this list that you get full discretion over. The state you live in, I don't know, like maybe your spouse lives somewhere and you have to move to a high tax state, right? Mm-hmm. School you went to, maybe you're already in school, you can't change that, right? Your income, sort of bound by, other factors, right? When, think about all the dentists who graduated in May of this year, right? In the middle of COVID shutdown, how many dental offices were closed in May, right? This income thing, they didn't have control over that. So the point of all this is control what you can, right? Mm-hmm. My ideal, well, I'm gonna tell you my worst. So I think the worst thing you could do is you go to UOP, San Francisco, and you become a general dentist in San Francisco, right? Because the daily rates are not very high for pay. The school is $600,000, right? Let's do it. Let's, UOP, ASDO, NYU, USC, right? They get a good rep for like how good they are, and I believe that. But the fact that it's $600,000, like my thing is like, is anyone looking at that before they go, or they just like, oh my God, I want to live in New York City or San Francisco or whatever.
Right.
Anyway, so you go to UOP, right? Let's say you do no residency. So you go to UOP, you become a general dentist, and you make $125,000 a year, right? Mm-hmm. is flat if you pay 20% a year. You'd never pay your loan off, right? Let's say you pay 30% a year. 2044, you're getting there. You still got $200,000 in loan. Let's say you pay 40%. Booyah. 20 years later, graduate in 2024, right? It's currently 2020.
Mm-hmm.
You pay this sucker off in 2038, but you're paying 40% of your income towards your loan. So look at, I did a thing on here that says remaining, let's look at remaining income, right? After your loan payment. Let's do remaining income, which is basically income after taxes minus this loan payment, right?
Mm-hmm.
Over time. And let's see if it just adds to the graph. Maybe it'll add to the graph. Can you live in 2042 on 45 grand a year, right? Because you're paying this loan back at 40%. So look, this is your income every year after you pay your loan, right? So that's why I say go to UOP, be a general dentist in San Francisco. It's probably the worst thing you could do, right? Go to NYU, be a general dentist in New York City, right? Those schools are fine. It's just like that amount of money is so big, right? So the other thing I'll say is if we can go to one of those schools, then you got to specialize, right?
Yeah.
Go specialize. What was that? That average was like 330. Yeah. Payback 40%. Booyah, right?
Mm-hmm.
This is 2027 now, but that's just for nothing. It's just for 4 or 5 years. Payback 20%. You're done in 10. So my point of all this is just know the numbers, right? So if you're going to go to a $600,000 school, know that either you're going to have no money in terms of actual income because you're going to be paying your loan back for the rest of your life, or you need to specialize, right? Or if someone's paying for your school, this doesn't apply to you, then go wherever you want, right? If you're going to go to a public school, it gives you a little more options because your debt's not as big. So you have the potential to you could specialize, you could be fine if you don't, right? And so, my point of all this is not, and I've said this a couple times, but because the first time I gave this, I think I just scared everyone, and a bunch of people became not pre-dental. And my reason for not doing dental school was not because of any of this. I mean, this stuff scared me, but I did the math and I saw it's payable, right? You just have to plan for it.
Yeah.
This is not meant to deter you from entering this profession because it's a really good profession. It's just, know the numbers, right? Don't go into it blind because you will get royally screwed by all this stuff. And, UCSF is really nice to you when you're applying, right? And they'll say oh, all of our graduates pay their loans back. No one has any issues. But, our UOP, right? Where are they going to be when you graduate from residency with this amount, right? You can't go back to them and say I want my money back, right? So it's listen to what the schools say, but be a little independent and do your own research on what the debt's actually going to do to you, and think about it, right? Think about psychologically how you're going to be. And I would say still go to dental school. Just choose a school that's affordable and have a plan to pay it back, regardless of where you go. Have a plan. I'm going to get out every paycheck. You can set it up on automatic, right? I say open a little savings account, and every month, and not even savings account, just from your checking account, set up an automatic withdrawal every month to pay your loan back, right? Auto pay take your income and times it by 20%. Every month, as soon as you get paid, it just automatically pays your loan back, right? Do something like that. Help yourself pay the loan off. The key to all this is have a plan. Just don't just willy-nilly say oh, it's fine. Everyone's fine. Everyone's happy. You don't have to live super cheap in school. I think you should live cheap if you're not making any money, but you don't have to you shouldn't be on the streets, have an apartment, because all that stuff's going to help your education, but just be, just be educated about the debt, right? And about the process. One of the questions Nick had brought up was about the I don't know, the pay loan, PAYE.
Yeah.
I don't know a ton, but to my understanding, that loan allows you to pay 10% of your income towards the loan every year. And then in 20 years, you have the option to get the loan forgiven. So let's model that, right? So I think if you go to school like NYU or UOP and become a general dentist, you might have to do something like this, right? If you can't, because it would be hard to live on paying all of your loan back all the time. So the pay program lets you pay 10%, right? I look at the loan, right? It goes up. You're not even covering, and the reason it goes up, so conceptually, why would a loan go up in value if you're paying it? It goes up if the interest that the loan is accumulating every year is greater than the amount that you're paying. right? So the loan balance, the starting balance, the loan you took has not changed because you're not taking on any more debt. But the interest is accumulating and making the loan bigger and bigger. And then you're paying to make the loan smaller and smaller. But if the amount you're paying is less than the interest accruing, then your loan balance actually goes up. So the pay program says you have a $600,000 loan, you make 125, you're never going to pay this off. So pay 10% a year and, forget about it. Don't even think about it. Just pay 10% a year and this goes up. And then the government will essentially forgive your loan. It's not as simple as that. I think there's more caveats to it. I don't know the terms of it, but I would be skeptical of this because the government tends to not just do free things. From a systemic standpoint, ultimately, someone's going to pay for this, right? Someone's going to pay for your $1 million. What is this? 2024. Your 15-year later $1 million loan, and taxpayers are going to end up paying for this. So I would encourage you to not have to use this. I think in certain situations you might have to, right, depending on your circumstances. But in my mind, I would love for everyone to go to school, know what they're getting into, even if you go to UOP or NYU or whatever, right? Know what you're getting into. Work on scholarships, work on grants. Look at the military scholarships, right? You think about for the military scholarship, right? A 3 or 4 year commitment to them, but they pay for your school. If you go to UOP and they pay for the $600,000 and you graduate, and you have to work for 3 years, but you're working, you're getting paid, and you have no debt, right? It's gonna take you a lot longer to pay that loan off if you're not in that program. Now you have to decide if you want to work in the military, whatever. But to me, if you're going to a really expensive school, then a lot of those kind of military scholarship programs make a lot of sense. You lose a little bit of freedom on where you work, and your income might be a little lower than private practice, but you have no debt, right? And so, it's something to consider. But does that kind of make sense?
Yeah, no, it totally does. So would you argue that it pays off to specialize? Because when I was looking at the graphs, it seemed like once you go into a specialty, you can typically pay it off in like 5 or 6 years. Whereas like for just general dentistry, it would take like 10 to 20 years, even if you choose the wrong percent to pay back.
Yeah, I think it's I believe it really pays off to specialize. Now, not everyone can specialize, and we as a country need a lot of general dentists. So I'm not saying that everyone should specialize, but I'm saying from a purely financial standpoint, from a purely income, loan payment, wealth creation standpoint, specializing can do a lot for you. When you think about kind of that average income, right, bumping up to 330. So let's focus on this line right here, right, which is the remainder. This is the remainder, meaning this is the income that you have to live on, after you pay your loan back every year. So, let's say you do an aggressive, let's say you do a 30% loan payment. The scale's not right, but if we zoom down, can you live on $130,000 a year? Probably, because you lived on zero when you were in school. So, and again, after 2031, it's not modeled properly here, but your income bumps back. You're no longer making this $100,000 loan payment. So, yes, I would say yes. I think it does pay off in terms of you being able to pay your loan back, and also you being able to pay it back fast and have a livable income. Because if you make, let's say the average was 190, and you pay 30% a year back, you're living on 70, which you can't, right? Again, it's not like you can't. It's fine. It's just it's a little tighter, especially if you're thinking about like buying a house, having a kid, or or whatever, right? There's expenses that come up that you're not going to have in school that you're going to have post school. And I would say specializing lets you achieve those kind of maybe personal goals a little faster, just from a purely numbers. But you have to like it, no point specializing if you're not going to like it. But I'm trying to give just kind of objective financial numbers, and yes, it does make it better.
Awesome. And so you mentioned, right, like there's going to be expenses that we didn't think about like after school. So one of them is going to be like having a family, buying a house, buying a car. And then I know a lot of people, they want to have their own practice at some point. So the best way to like go about getting those things would just be paid off as fast as possible then, right? Or unless there's more stuff.
I would say yes. I think there's no science to it, and your life is going to be what your life is going to be when you graduate. And maybe you personally, you're like, I need to have my own thing. I cannot work for somebody else. And in that case, you're going to have to go get a loan, like a business loan, start a business, start a practice, grow your patient base. The issue I see with that is if you have a lot of debt and you start your own practice from scratch, the odds of your income being very high for a couple of years are pretty low. You're probably gonna have pretty low income for a couple of years, which is fine if you have no debt. You can kind of just scrape by and make it work. And then, but when you're starting on that, when you have that debt and the loan, there's minimum payments that you have to make every year on the loan. I'm telling you, like, pay 30%, but you can't do zero. There are minimum payments that you should be making, or you have to make. So, like, can you even afford the minimum payment if you have zero income, right? That to me sounds really hard. And so in my head, if I were doing this, I would likely, if I had $500,000 in debt, I would likely work as an associate in somebody's office for a couple of years where you have kind of a guaranteed income. Aggressively pay your loan back, get it down to, 100, 150, 200, and then go start your own practice, right? Then go get a loan. It might actually even be hard for you to get a business loan with the student debt that you have, right? Because, whatever, right? So I think realistically, and this is what we're sort of seeing in the offices, is that most new grads, they just want to work for a couple of years, right? They've made no money. They need to make some money, pay the loan off. And then, in 5-10 years, maybe they go start, they realize they want to do their own thing and they start their own practice. But at that point, they're debt free, whatever, right? It's really dependent on your circumstances. But I would say nowadays, and I think this is bad. Like, I think the dental industry is, there's a lot of talk about consolidation and group dentistry and big DSOs and corporate practices. And like, well, why do you think that works, right? That works because you have a workforce that just needs to make an income to pay their loans off. Like, if people were only graduating with $100,000 in debt, likely everyone would be starting their own practices, doing their own thing. There would be no reason to join a big corporate group, right? But when you graduate with $500,000 and a corporate group comes and says to you, I'll pay you $200,000 a year to work, of course you're going to do it, right? It's a guaranteed salary. You're going to do it. You don't have to set your own schedule. You don't have to learn any accounting or HR. You just show up and you do dentistry and you get paid, right? So that model is very appealing, and I get that. And there's a reason why that model is, talk about consolidation of the industry and the growth of corporate dentistry. Like, that's not just happening because there are good companies building big businesses. It's happening because there's also a workforce.
Oh God, Rowan, you cut out for a second. Are you good right now? Okay, yeah, connection's good. Okay, sorry.
Yeah, no, you're good. No, but basically it's, this debt is feeding corporate dentistry, right? So like, because people have a ton of debt, they need someone that's going to give them kind of a stable income. And corporate dentistry, provides that, right? To their credit, they've done a great job of sort of capitalizing on this demand. And they're, people go work for a corporate dental group, then they're able to pay their debt back, right? It's not all bad, but it's, you sort of have to think at the systemic reasons why some of this stuff is happening, right? Like, I was at an interview at I won't say the name, but at a certain dental school in California, and they were talking about how bad corporate dentistry was, right? And like, oh, it's, it's not private practice. Like, everyone, used to like start their own office, and like, sort of, I did it with my own two hands, and now everyone just corporate and like doesn't care about the patients and over treatment and overcharge. And I'm sitting there thinking like, well, your school is like, let's call it 400,000. Like, of course, like, if I went here and I had $400,000 in debt, I would want to go work for a corporate office because they give you a guaranteed salary, right? Or maybe you go be an associate in a private practice, but that's, whatever, right? There is an incentive to start your own practice, but the crushing factor of the debt is sort of preventing that in some cases. And so, it's good to look at the dental space as an ecosystem, right? There's inputs, there's outputs, and everything is sort of working together. And a lot of things cause the other. And so, I think your original question was, should you start your own practice? I say yes. I think it's amazing. Like, I think it's the best part of this field is that you can still have your own like solo practice that you fully control.
Right.
I just think do it in a reasonable timeline that allows you to get out of debt, right? And that probably involves you being an associate for 5 or so years while you kind of aggressively pay down the debt. But
so what about the like military and Navy scholarships? Like, when would you recommend that like people start considering taking that on, and maybe it's worth it? Like, if you go to USC or NYU, like, and with all that debt.
I think any school above kind of 350, I would say any school above like 350 grand. If you're going to be a general dentist, I would say any school above, 300, I would seriously consider it. And then if you're going to specialize, which most people don't even know this when they start school, but if you're going to specialize, then I would say maybe any school over 350 or 400, I would seriously consider it, because, let's say you do UOP, right? And you do a 3-year residency.
Yeah.
Or let's say you do no residency, but if you make 190 grand a year, so let's say the military pays you 100, right? But in private practice, you can make 190, right? Let's say it's double in private practice. You're making 190, but the military allows you to be debt-free and no obligation to the military after 3 years. So what percentage do you need to pay back to pay your loan off by 2028, right? Probably not even 50%, so 60%. Let's say 65, okay? Okay, so now you're equal. So now you went to dental school, you paid yourself 600 grand later, you make 190 a year, and in 3 years, you'll pay your loan off, right? Because you paid 65% a year. Mm-hmm. So what was your real income during those years? 1900, 1938. You made $1,900 for the entire year because you were paying your loan off, right?
Right.
This is the pay it yourself option compared to the military. If you want to be done in 3 years. Now you go to the military, this amount becomes 0. Your income drops to 100, but 100, and then you pay 30% in taxes. You have $70,000 of real income, and you're debt free, mm-hmm. right? So in my head, it's a no-brainer, because to achieve that same outcome without doing the military scholarship, you would only be able to make $2,000 a year in total income after your loan payment. Mm-hmm. And so, it's an extreme example, but to me, it's like, and those scholarships are not easy to get. It's not like, oh, I want to do the military scholarship, let me just go get it. Those are hard to get. But I would, start that process early. Start talking to the recruiters for the military. This, Navy, Air Force, the whole gamut. And you get to be in the military. I think there's a unique experience in that, in terms of kind of a leadership standpoint and just learning more about it. I know very little about it, but the math explains itself, right? I don't think I have to justify it. The military can put you in a really good financial situation if you kind of commit to them. Well, you have to commit to them for those 3 or 4 years. But,
right,
yeah.
Definitely. So, and last question I have for you is, do you recommend that once dental students come out of school, like they get a dental CPA, so like a dental specific accountant? Would you recommend that? Or like, is it needed?
So it's a really good question, and it's very common nowadays for dental students coming out of school to sort of be, I would say, courted. How animals like court each other for like marriage or for breeding. Sort of like that, right? Like you're in dental school, and then when you graduate, like all these CPAs, all these attorneys, all these like management companies start coming to you saying like, let me manage your practice, like let me do your finances for you. And one thing I'll say, this is a general statement, and there are really good dental CPAs, and I know many of them that are excellent, but one thing I'll say is anything with the word dental before it is more expensive. So you can go to Home Depot and buy a screwdriver, and it's like $5. You can go to Henry Schein, which is a big dental supplier, and buy a dental screwdriver to fix a dental air compressor. So not even a screwdriver that's doing anything in someone's mouth, like an actual screwdriver, and it'll be like $25, right? So I'll preface it with saying anything with the word dental or medical or professional before it is more expensive. I'll give you an example right now. Look at the student loan rates for undergrad versus professional. It's higher, right? So anything with the word professional, dental, medical is intrinsically more expensive because they're marketing to a higher income crowd, okay? So have that in mind when you're looking for a CPA. A dental business is a business. It has income, it has expenses, it has employees, right? From an accounting standpoint, a solo dental practice owned by 1 or 2 people, 1 or 2 dentists, is not different from a other business. Like, why do you need a dental CPA, but the bakery doesn't need a baker CPA, right? Like, I don't think it's completely necessary. There are certain things that those CPAs might be able to help you with in terms of like reporting on your dental procedures and things like that. But I've done this, and it's not crazy complicated. You need a CPA, that's for sure. I'll say one thing: don't try to do your own accounting. You can maybe do your own bookkeeping, but in terms of taxes and savings and kind of entity creation and structure, you need a good CPA, and that CPA probably works with an attorney. So I will say that. Don't try to, there's a lot of stuff you should do yourself, but I will say do not do yourself. Don't DIY your CPA, right? That being said, the dental CPA, I'm on the fence about. They are more expensive. They're dental specific, but there are a lot of just general CPAs that tend to have a lot of clients that are in healthcare. So a lot of their clients are doctors, physicians, dentists that own their own practices. And I think that person is just as qualified as a, dental CPA. There's no extra real education. Maybe there's a certification class or something, but it's not to knock on them. Like, I basically think a dental CPA is just someone who's a CPA, but they just work exclusively with dentists, right? And you have to are they more expensive? Because maybe they're the same price. And then it's like, okay, great. Well, they work with a lot of dentists and maybe they can introduce me to other people and whatnot. But I would argue that you don't need a specific dental CPA. And I would argue that if you're just coming out of school and you're making $100 and something grand a year as an employee, you need very little accounting help. Like, your financial life is very simple. You have the loan, you have your income, you pay back every month, right? You don't have your own business, you don't have any of that. So I would say your accounting world is simple enough for like TurboTax, right? You don't need any besides that. Now, when you start a practice, I think you should get a CPA, right? Mm-hmm. That's important to have a good CPA. I'm just not totally sold on the dental, the necessity of a dental CPA right away. And the one thing I'll say with dental CPAs is they tend to tack on other services. So it's not just CPA services, but they'll tack on like, we have this company that we work with that helps you with like your billing. And we have this company that we work with that helps you with your HR and your payroll and things like that, right? So it starts to become like this all-inclusive experience, and that can get really expensive. And they're usually priced on a percentage of your revenue. So they're not a flat fee. Basically, as you grow, their income grows. And that can be good, but that can also be bad because they're essentially getting a cut. Like, you're in the office grinding away on patients and they get a cut of it, right, for running your payroll. So, I tend to be a little skeptical of everything, but, know the facts, right? Figure out what people are paying in your area. Figure out where people are paying for regular CPA. Look at dental CPAs. Look at, the point of all this is like, just do your research, right? Do your research on debt, do your research on practices, on CPAs, right? I'm happy to talk about that stuff or give recommendations. But anyway, hopefully that answers.
Yeah, that definitely did.
I mean, right? It's the dental CPA in a certain sense gives you a sense of security, right? You graduate school, you have all this debt, you don't know anything about business or finance, and you think like, oh my God, like, how can I run a practice? Like, I don't know how to do any of this. Like, I need someone to help me. But I think what you'll learn is if you take the time to really learn stuff and educate yourself, the stuff is not that complicated, right? And then all that extra income that you would have been paying to the CPA now gets to come to you. You can use it for your family, for charity, to grow your practice, whatever. So just, be smart about what you're spending money on, especially if you've got, a bunch of debt in the background.
Mm-hmm. That's a lot of great advice, Rowan. So that'll be it for this episode, everyone. Rowan, thank you again for your time. So you mentioned, you listed your email and your phone number in the document. So is it okay if our followers reach out to you through those means?
Yeah, sure. Yeah, feel free to emails. I mean, text is fine, but if it's a bigger audience, then email's probably a little easier. I'll be able to mark it as unread and then answer when I can. Yeah. So let's just do email for now. But I'll happy to do other Zooms and kind of one-on-one stuff if needed.
Awesome.
Yeah.
Awesome. All right, everyone, if you haven't already, make sure to hit that like and subscribe button. And if you want to be notified when we post new content, hit the notification bell. If you have any questions for us at FutureDDS, you can DM us at _FutureDDS, and we'll try to respond to you as soon as possible. And until next time, see y'all then.
Sounds good. Thanks.